Imagine buying a house, giving it a facelift, and 6 months later the bank hands you back about 90% of the cash that you tied up. So you're now almost whole again, the place pays you rent every single month, and you still own a solid 25% equity slice that can keep growing in the background. Stick with me and I'll map out the blueprint, walk you through the exact numbers from my latest deal, and flag the pitfalls that first timers usually miss. A BRRR is a straightforward single let that keeps things cleaner, one tenancy, fewer moving parts, and crucially, you recycle most of your deposit and cost, so you're not forever saving the next lump sum. That's why the majority of my portfolio is BRRR. Buy, refurbish, rent, and refinance. So you buy below market value, you refurb to force the value back into the property, you rent to prove the income of that property, and then you refinance it at the higher value, so you can pull most of your cash back out and do it all over again. Therefore, building your property portfolio with the least amount of cash. So that loop is the engine of BRRR. Now let me bolt on some real numbers of a property I've just finished so you can see it in action. So the first step is to buy a property. I bought one 6 months ago for £135,000 in cash. Now, if you don't have a big pot to buy something like that in cash, that's fine, and it's way more common to use something like a bridging loan. Just remember to price in the interest and exit fees that are included in a bridging loan. But on top of that, you have your closing costs, so that's your stamp duty and your solicitor's fees. And for this property, that came to about £5,600. Once you've purchased that property and got the keys, it's time to refurbish it and put some value back in. That was about £12,500 of refurbishment. Now this took me slightly longer than I was expecting, 6 months in total. That was about £1,500 of holding costs. So all in all, for me to purchase and refurbish a property and get it back up to a higher value, it cost me about £154,600 all in. If you're estimating the refurbishment ahead of time, try and add on an extra 10% to the refurb cost as a contingency and an extra 2 months of holding cost time. Refurbishments tend to run over, and that will account for that risk. So now this is quite clearly a lot of cash out of my pocket, and it's time to move on to the third step, which is rent, to try and get some cash flow back to me and prove the property is bringing in an income to refinance it later. So I managed to let out my property, they signed this morning, £895 per consecutive month. And again, if you're estimating stress tests with a rent that's 10% lower than what you'll guess it'd be. And then the final step of BRRR is where you eventually get the majority of your money back. So my refurbished property was valued at £185,000, which is an amazing value add. I've gone from 135k to 185k in 6 months by spending 12.5k on refurbishments, plus the additional costs. And as part of the refinancing strategy, I can release 75% of that value, typically £139,000 that goes back to me, which, comparing it to the £154,600 I've spent overall, that's around 90% of my outlay. And the refinance product that I've bought is a variable interest only mortgage. That's £560 per consecutive month. So what's the end result for this property that I'm talking through here? Well, I've managed to add £50,000 of value. I spent £154,600 and I got back £139,000 from the refinance. So that means I have £15,600 of my own money still left in this property, but I keep 25% equity of it. I own 25% of it and the bank owns 75% of it. So although I was in a fortunate position to buy this property in cash, most of my investments aren't full cash, and I tend to use bridging loans to purchase properties. If I had done a bridging loan, the typical bridge deposit would be about 25% of the value of the property, so around £34,000. And bridging loans tend to charge monthly rolling interest, so it's probably safe to assume right now, as of June 2025, it's about 1% per month. And that over 6 months, plus all the costs of bridging loans, which they love to add on, would be about 10k of costs. And if we add on the refurb costs, the holding costs, and the closing costs that I would have to pay, that would probably be about 20k of additional costs overall, meaning that if I was purchasing it through a bridging loan and refurbishing it, then overall that would be around £64,000 instead. So I'm still recycling 80 to 85% of the cash that I'm putting in, £64,000, but I'm perhaps leaving £25,000 left in the deal rather than £15,600. But don't worry about using a bridging loan. There is a lot to them, but they're perfect for this strategy. And momentum matters more than the absolute bottom line, especially on your first purchase. Now, I know I ran through bridging loans extremely quickly there, and I will cover it in more detail in a separate video, so subscribe below so you don't miss it. Now that I've been through the BRRR, what does that that actually mean for the investment that I've made and the money that I'll get? Well, I have a property which is generating me $895 every single month, minus any of my mortgage fees, my management fees, the maintenance and the insurance. So overall, I'm looking at about £225 per month. And that's gross, so before tax. And because I run this through my limited company, I pay about a 19% corporation tax on that, which then net would be about £182 per consecutive month. So that means for the £15,600 that I've got of my own money tied up in this property, that £225 a month over the year gross is giving me a 17.3% gross ROI. But after tax, that's a 14% net ROI. So if you compare that versus, say, a savers account, which a good one right now might be around 5%, this is a pretty good investment purely for the rental alone. And not only that, the property is also generating me capital growth too. So for the area which I bought the property in, which is Newark and Sherwood, it went up 5% in the past year and around 25% over the past 5 years. And that's on the total property value, not just the part that you have equity for. Okay, so we've covered that BRRR sounds great, but what are some pitfalls to watch out for? First is valuation risk. So when you're refinancing, budget for a 5 to 10% haircut off what you think it is actually worth. Second is rate risk. Now that goes for both the purchase, if you're using a bridging loan, and the refinance too. Model payments are about 2% above the current average rate, just to make sure that you're hedging that risk. The third is time. Renovations can overrun quite easily, and bridge overruns eat into your profit really fast. That's what makes bridging loans scary. And then my fourth and final pitfall is location. So margins vary wildly between areas. Always run local comparisons of nearby properties instead of widespread. Sure, a 5-bedroom HMO or a serviced accommodation or a high-spec retirement unit can net you more over time, but you'll often drop tens of thousands on licensings, furnishings or specialist compliance and leave most of your deposit locked away. With BRRR, I've recycled the bulk of my cash, kept management simple, gained a bunch of experience, and I've lined up funds already for my next deal to go through the cycle again. So speaking of which, if you want to know how I find the best and most appropriate areas to invest in, check out my video over here on using government housing data to find the top property areas nearby to you. But also in the comments below, please tell me if you're starting out with BRRR or eyeing a more advanced strategy. Thanks for watching, and I'll see you in the next one.